man, I want that CD right there.
I want it too. You know what? I'm just going to buy it right now. I'll use my credit card.
You sure?
Hey, it's no big deal. Hi, I'd like to order a CD. Yeah, I'll just charge it on my credit card. Charge it. I'd like to charge it on my credit card. Charge it.
Oh man, how am I supposed to pay this off?
Wow, that's not a good position to find yourself in. Hello, and welcome to the Business Basics series. I'm your host, Candace Williams, and it's time to find out why you should be careful with credit. A credit card. Free money. You can go to almost any store, hand the cashier a plastic card, and you're off with the goods. It's that easy. Americans are consumers by nature. Every day, we're enticed by the latest electronic gadgets and hip new fashions. It's a constant struggle to avoid these temptations, especially when you have a credit card. Credit cards just make it too easy to have everything you want. Today, Americans owe credit card companies approximately $360 billion. That's a lot of zeros and a lot of debt. Consumers get into trouble when they charge more than they can pay for in a short period of time. They need more time to earn enough money to pay their accounts. While they are working to earn the money, the clock is ticking, the interest is accruing, and they keep charging. It's a vicious cycle. Credit card companies lend money to people for a profit. They are investing in the idea that consumers want to buy things before they have enough money to pay for them. Consumers agree to pay interest on borrowed money for this convenience. I'm sure you've seen advertisements for credit cards at a low 5.9% APR. Well, 5.9% is an interest rate. The credit card company charges the customer interest for the privilege of using the money for a certain amount of time. Take a look at this scenario. Say it's October 1st and Sam has his eye on a new stereo at the electronics store. The price is $500, but Sam only has $20 in his wallet. Sam makes about $50 a week, flipping burgers part-time. So, if he doesn't spend any money, Sam could pay cash for the stereo in 10 weeks. Sam really wants the stereo today, and he just happens to have a credit card. So, he lays down the plastic and pays for the stereo. Now, before we go on, how much do you think Sam will pay for the stereo? $500, right? Wrong. Let me show you why. Sam receives his first credit card statement on October 15th. The balance is $500. He mails $75 to the credit card company. Now his next credit card statement arrives on November 15th. But what's this? The balance is $438.52. Hey, that doesn't seem right. $500 minus $75 should equal $425. The credit card company added $11.52 in interest to the bill. Guess what? They will keep adding 22% of the unpaid balance every month until the account reaches a zero balance. That's the catch. So Sam will pay a lot more for the stereo than he anticipated. If he pays $75 a month, it will take over 7 months to reach a zero balance. And Sam will have paid a total of $538 for the stereo. Some consumers figure the extra $38 in interest is fair for the privilege of using that stereo for the last 7 months. But what happens if Sam doesn't pay off his account so quickly? Most credit card statements list a total due amount and a minimum due amount. The minimum due is just that, the smallest amount the credit card company will accept to keep the account in good standing. It's usually figured around 3% of the balance due. In Sam's case, it's $12 for the November statement.
Wow! If I pay the minimum due, I'll have more cash to spend on myself this month.
Now, Sam's entering into the dangerous territory. Low minimum due amounts are convenient when you're strapped for cash, but it's a very bad idea to rely on them. Do you have any idea how long it would take Sam to pay off $500 if he only paid $12 every month? At 22%, it would take Sam over 6.5 years to pay off $500. And here's the real burn. That $500 multiplied to $953. That's $453 in interest. So, the key is to pay off your balances as quickly as possible. Time really is money when you're borrowing. Interest isn't the only cost associated with credit cards. Credit card companies can charge additional fees for late payments and for charging over your credit limit.
My credit limit? I didn't know I had a credit limit.
Of course you do. A credit limit is the maximum amount the credit card company agrees to lend you when they issue you a credit card. When you sign your name on the application, you agree to all the terms in fine print on the back of the agreement. Sounds unfair, huh? Credit cards aren't all bad, though. They provide some definite advantages, like making hotel reservations, renting a car, even purchasing items over the phone or online requires a credit card number. And credit cards can sure rescue you in an emergency. If you live on a tight budget, having car trouble or making a visit to the doctor can leave you with no money until your next paycheck. The biggest advantage to having a credit card is building a healthy credit report. This may not sound like a very exciting advantage right now, but believe me, someday your credit rating will affect almost everything you do. Let me explain how. The term credit means confidence or belief. Credit is a person's reputation for paying bills. In America, 3 major credit bureaus keep track of every single consumer. If you have ever purchased anything on credit, chances are you are on file at all 3 of the credit bureaus. Kinda creepy, huh? Well, as long as we maintain good reputations, credit bureaus actually work to our advantage. Credit bureaus gather information and assign each consumer a credit rating based on the way he or she handles bills and credit cards. Why do they do this? Because businesses pay for the information. If you plan to rent an apartment, the landlord, the phone service, and the utility companies will contact the credit bureaus to get your credit rating. A good rating means you are a safe risk. Landlords will lease the apartment to you, and utility companies will turn on the power in your name with little or no deposit. A bad credit rating, however, can really work against you. This is America. Landlords and utility companies don't have to risk non-payment. They have every right to require a deposit. Creditors hold on to the deposit to guarantee you will pay them in the future. And the buck doesn't stop there. With a bad credit rating, you may not be able to land the job that involves handling money. Banks and retail stores often check credit ratings for applicants. Bad credit ratings indicate bad judgment. Banks and businesses just can't take the risk of hiring someone with bad judgment to handle their cash. Oh, and with a bad credit rating, you can still buy a car. But the finance company will charge you ridiculous interest rates, which makes it very difficult to pay off the loan. Bad credit is a big roadblock. You should avoid making mistakes that can end up on your credit report. Those mistakes last for 7 years, and it takes a lot of time and effort to clean up a bad credit history. Having no credit rating can be as limiting as bad credit. Without a credit rating, businesses don't know anything about you, which is almost as big a risk. That's why it is so important to build a good credit history. There are a number of ways to do this. Opening a checking or savings account is a good start. Make sure you keep track of your account balance at all times. Enter every deposit and withdrawal in your check register. Make sure your register agrees with your monthly statement and never let your balance fall below zero. Overdrafts cause everyone problems. Overdraft penalties will cost you for every check that doesn't clear your account.
My dad makes payments on his truck. Can I do that too?
You're talking about buying on installments or taking out a loan. That's an option. That's not a credit card, but it is a form of credit. Buying on installment is usually limited to high-dollar items like an automobile or a home. Unlike consumer debt, loans are secured by collateral. That means if the borrower fails to pay the loan, the bank can take the item that the borrower pledged as collateral, such as a car, a boat, or a house. Also, the payment arrangement for the installment loans is more structured. Banks figure a payment schedule that is feasible for the customer. The schedule determines the payment amount, the monthly due date, the total of the payments, and the length of the loan, or the due date for the final payment. The principal is the original amount that is borrowed. The interest accrues, or it is added up in various ways, depending on the type of the loan. All of these terms are worked out between the bank and the customer before the customer receives the money. Installment plans or loans usually require a down payment or a certain percentage of the item's purchase price. For instance, if I want to purchase a car for $10,000, the bank may require that I pay $2,000 in cash before I can borrow the rest. The down payment guarantees the bank that you intend to fulfill your obligation. Banks usually require borrowers to have a credit history, which makes it difficult for young people to borrow. However, they will loan to first-time borrowers who have a cosigner. A cosigner agrees to pay the bank in the event you cannot or will not pay the loan. Therefore, cosigning a loan is a big financial responsibility. The easiest way to build credit is to apply for and use a credit card wisely. Credit card companies aren't as picky about credit histories. They'll offer a credit card to just about anybody once. It's not hard to find a credit card application. In fact, more often than not, they have a peculiar way of finding you first. Check your mailbox. But don't be so quick to sign up for the first offer you receive. It's important to examine the terms of the account carefully before you agree to them. All of the conditions are listed on the credit card agreement, so read the fine print. Determine the interest rate, or the APR, and how the interest is calculated. Also, find out about the application fees, membership fees, prepayment penalties, late payment fees, and over-limit fees. Compare several offers. Some credit card companies don't charge as much just to win your business. If you have no credit or bad credit, you may have to accept a high-interest, low-limit credit card at first. Beware of low-interest offers or 6-month same-as-cash promotions. Usually, low-interest rate offers only last 3, 6, or 9 months, and after that period, the rate increases. If you keep a balance, the higher interest rate can really add up quickly. 6-month same-as-cash offers are more common with store credit cards. For example, the electronics store may offer a credit card limit of $1,000 for 6 months with no interest. Wow, that sounds too good to be true. Well, it is. Here's the catch. You must pay off your balance before the 6 months is up, or not only will they start charging you a high rate of interest, they will add interest from the original date of purchase. But you thought you had 6 months. No interest, right? Again, read the fine print. If you have signed a contract, you agreed to their deal. Always be cautious of deals that sound too good to be true. The key to successfully managing a credit account is simple. Don't purchase anything you won't be able to pay for by the end of the month. Most credit card companies allow their customers a grace period, usually 25 to 28 days. If you pay the entire balance within that period, they won't charge you interest. Hey, there is such a thing as free money. Here's a good tip. Try deducting the amount of the credit card purchase from your checking account register. When you receive your credit card statement, you will have the money reserved to pay the bill in full. If you establish a good payment history with your credit card company, they will eagerly offer you high credit limits. Don't be fooled. Just because they allow you to charge more doesn't mean you can afford it. Kindly accept the offer, but don't abuse the privilege. Higher credit limits look good on your credit report as long as the balances are paid. Eventually, you will qualify for lower interest rates as well. Don't wait around for credit card companies to offer them to you. Higher rates make them more money. Call the customer service representative and request a lower rate. Chances are they will give it to you to keep a satisfied customer. If you manage a credit card wisely, you will reap some first-rate benefits. Successfully managing a credit card can lead to a healthy credit report. With a healthy credit report, you can qualify for lower interest rates and for loans for larger items like houses or cars. It's a good idea to check your credit record on a regular basis. Transactions and accounts can be mistakenly applied to your credit record. You are responsible for monitoring it. To do this, contact any or all 3 major credit bureaus. Good credit can be a wonderful thing to have, and it can be dangerous. Don't give in to temptation. Spend wisely. It's your money. All you have to do is be careful with credit. Thank you for joining me. Goodbye.
View all 12 titles in the Business Basics series.
The ups and downs of stocks.
The profits and pitfalls of mutual funds.
Supply and demand.
The profit and loss statement.
The accounting equation.
Careful with credit.
Advertising tactics.
What's next?
Patents.
Copyrights.
Business writing.
Don't look at your hands. An introduction to keyboarding.
Excellent videos, check your teacher's video company catalog or call us toll-free for a new catalog at 1-800-262-8837.